I just wanted to, although I'm not doing the trade of the week, I just wanted to point out that it actually, as soon as it got out of the trade, the following day, it came right down to the take profit line, as I suspected it would. So the lesson definitely was place the stops in accordance with volatility. We did not do last time. You can be sure the US 500 is going to stagnate. It's going to slump slowly, probably at least down to this band, the bottom of this band here, and maybe even lower. We are in totally historically unknown territory right now. Every school in the province is closed. That's never happened, I'm sure, since World War One. I'm not aware of any province-wide school closing before. So can't imagine what people who don't work at home or don't have experience homeschooling their kids are doing. I don't know what they're, because daycare centers are closed, out of school care centers are closed. I don't know what they do. I don't know what the plan is going to be for most people. And there's no hardly any warning. The government was slow to react, but I guess I have to praise it for having acted, for having at least made a decision. Uh, is it an overreaction? I guess only time will tell. Okay, I think I'm just going to go straight into the educational portion because I didn't have time to think about this or to plan. I did work on some slides to my credit over the weekend. Principle number 5 is avoid the crowd. I was going to, if I could do video game examples, boy, there's a lot of good video game examples about how avoiding the crowd is a useful thing to do. And this is very timely considering what's happening right now. Social distancing is the new buzzword. Avoiding the crowd could save your life, and it will definitely protect your account. Do not trade necessarily with what everyone else is doing. Now, you might think this is a bit paradoxical, and it is a little paradoxical because you want to trade with the strong. You want to trade with strength, which means that you're trading with the big volume. You're trading with the dominant trend, but it doesn't mean trading the way everyone else is trading. And if you looked at the Aussie yen trade that we were in last week, you would have seen that the crowd was long. Almost everybody was long, as was I, because we thought here's the chance for the recovery to happen. I should tell you that sentiment, I believe, and I'll talk about this a lot later, but sentiment is not a predictive indicator. Price affects sentiment, and then sentiment reacts to it, which is why all of the sentiment indicator, the sentiment, big order, even order flow isn't necessarily predictive. Price is the main predictor, and if all the information that you need to be able to trade is in price. But um, if you see a trade that's very crowded, it's a good chance that the people who are in it are going to be disappointed. The crowd is wrong most of the time. It's not always wrong. You can't just trade by going against the crowd, and we're going to show that. We're going to do some experiments. When we get to the experimentation part of what I'm doing, I'm going to be able to show you. But for now, avoiding the crowd is usually good. Do the opposite of what the majority of people are doing the majority of the time, and you'll be better off. Okay, we're going to continue talking about BabyPips and what we learned from BabyPips and what BabyPips has got completely wrong. Chapter 2, by the way, if you're giggling, that's my son, Dynamite. He's enjoying some YouTube right now while I'm doing this. They've both been pretty good following the first day. I don't expect a major rebellion on the first day, but by the time we get to Friday, it's going to be pretty darn interesting. All right, so the chapter 2 on BabyPips is called How Do You Trade Forex? And it occurs to me that I forgot to duplicate this tab so I can read my notes. By the way, to follow along on the BabyPips chapter, you go to babypips.com/learn/forex/make-money-trading-forex. But if you just go to the BabyPips school and go to chapter 2, you'll see it. All right, how to make money trading Forex. Everything on this page I think was good. The mechanics are similar to other markets. That's true. The objective is to exchange one currency for another and then to bank the difference. That's right. That's essentially what we're trying to do here. An exchange rate is the ratio of one currency valued against another. Exactly. Basically, and that's the only thing that we can say about exchange rates, really. They may be based in some type of fundamental aspect that's happening in the market, but generally speaking, it's just speculation on what one currency is going to do against another one. Currencies are always quoted in pairs, and you're buying one currency while selling another. Every time that you place a trade, whether you're long or short, you are simultaneously buying in one currency and selling in another. You're buying in the base or transaction currency, and then you'd be selling in the quote or counter currency. So you can see here in the example, GBP USD is the pound to the US dollar. The first bit of this is the currency that you're actually speculating in, whether you're long or short. And the second currency is what the price is measured in. The numbers on the chart will be reflected in this currency. So different terms get used. Sometimes people say base, sometimes they say transaction, but that's for the first part right here. And the second half is the quote or the counter, which is this part here. Everything on that BabyPips. If you go to BabyPips, they have colorful graphics. They have easy to understand language, and it's a great way to learn as long as they're giving you good information. And on this page, they gave you good information, good basics. So good job, BabyPips. How to make money trading Forex. The exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency, right? So basically, if we were looking at the euro to the US dollar, 1.112 means that you have to pay 1.112 US dollars to buy 1 euro. And if you're long, then you're buying the euro and you're selling the US dollar. In that case, if you believe the euro is, if you were long, you would believe that the euro is going up against the US dollar. Otherwise, if you thought the US dollar was going up against the euro, you would be short the euro to the US dollar, also known as fiber. This currency pair has a nickname called fiber, which is how I usually think of it. You'd be selling euros and buying US dollars, basically. So there you go. Long equals buy and short equals sell. That's something that you just have to know as a beginner. Everything on that page is true. Bid and ask on the chart. Bid is the bottom line and ask is the top, usually. So let's look at a chart. And let's zoom in. This isn't a currency pair, but let's just look at now my computer is completely slowed down, eh? Oh, there we go. Response. So you can see here, the red line is the ask line. The black line down here, or the gray line, is the bid. The bid is almost always underneath the ask. And the difference between these two lines is called the spread. And it's the amount that you pay on every transaction. It's the broker's compensation and their basically their risk avoidance mechanism. The bid, which was that bottom line that we just saw, is the price at which the broker is willing to buy the base currency in exchange for the quote currency, right? They'll give you the worst of the two prices. If you were short, the broker would buy from you at the bid price. And then the ask is the price at which the broker will sell the base currency in exchange for the quote currency. If you're long, the broker will sell to you at the ask price. And then the difference between the bid and the ask is the spread, as I said. If all of this is confusing, after spending several weeks or months dealing with this, it will all become very clear. And also, it's not crucial to the mechanics of making money in Forex, but it's something everybody should know. Here it is, all the data in one chart. So here we can see this is a chart of the pound to the Swiss currency. The base currency is the pound. The counter currency is the Swissy. The let's see. The ask price is actually over here on the right, and the bid price is the lower one down here on the left. But we can see if you subtract the higher from the lower, you would get the spread, but the spread is listed here in points. 61 points means about 6 pips is your spread, which is kind of a lot. You can see that it's much lower on Fiber because it's a much more liquid pair and people are trading it more often. 2 pips spread is what you're paying there. All right, so then on 2.2, chapter 2.2, the second chapter, the second topic, which is know when to buy or sell a currency pair, I could not find anything worth commenting on or talking about on BabyPips. This is what drives me crazy about BabyPips. Sometimes it has good basic information for new traders, and then other times it just has complete garbage. What is this section even about? I don't know. It seems to consist of a bunch of binary examples. So it's like if you believe statements, if you believe that the Japanese investors are going to be pulling US dollars out of the market, then what will that do to the US dollar kind of thing? Then you would sell the US dollar because you think Japanese investors are going to be pulling their money out. But they never explain why you would have such a belief or a bias in the first place. And they don't explain why it's realistic to expect that those price movements would even match your expectation. I guess the point is to make sure that you base your expectations on the base currency and not the counter currency. They don't want you sit thinking, oh, well, I think that the euro is going to go up, so I'm going to be short Fiber. No, you would be long Fiber if you think it's going up. You got to make sure that you don't mix up the base and the counter currency. I agree with that. But either way, the whole thing just seemed sort of like clickbaity nonsense. The title itself is pretty clickbaity. And I had some notes about that. What was I saying about this? Yeah, the chapter sounds like a classic spam advertisement. So yeah, it doesn't really matter if you get the names mixed up. What's important is that the first currency is the currency you're buying. The second is the currency that you're selling if you're long. And it's vice versa if you're short. It is confusing. I was confused. I was constantly getting confused about which is which when I started off. But after a few weeks or even a few months of sort of trading on a demo account, you eventually get the hang of it and you start to consider the common pairs that you trade as a single entity. So you don't have to really think about which is which. You just sort of think of it as one thing. And it's important to note that you can't trade the reverse of any pair. All brokerages will give you, for example, Fiber, which is euro to the US dollar. They will never give you the inverse, which is the US dollar to the euro. At least I've never met a broker that does that. It would be extremely confusing if they did. To be able to trade the inverse, all you have to do is reverse your trade. So, if you think the euro is going down, then you would just sell Fiber. All right, margin trading. Because most people don't have enough money to be able to trade a full lot of a currency. A full lot is 10,000 units. 100,000 units. Most people don't have $100,000 to be able to trade, the US dollar to the Canadian dollar. So what almost every brokerage offers you is a certain amount of leverage to be able to control a much larger amount of money with a smaller amount of account monies. Standard lots are 100,000 units, mini lots are 10,000 units, and micro lots are 1,000 units. Margin trading lets you open larger positions using much smaller amounts of real money in your account, which is good because otherwise you would only be making pennies on a trade and risking a lot of your own account. But it's also a double-edged sword because with margin, your losses can be much higher. All right, rollover. This is also called swap. In fact, it's more commonly called swap. Rollover is a term borrowed from futures trading, not foreign exchange. When you hold positions at the end of a trading day into the new day, you'll pay or earn the interest rate differential on those two currencies, the two currencies in the pair. So interest is paid on the currency that you're borrowing, and it's earned on the one that is bought. And if a currency has a negative interest rate, as now many or most of them do, then the inverse is true. I would guess, though, because brokers hate paying positive swaps, that the day of the carry trade is rapidly coming to an end. We'll talk about carry trading later. But basically, it's a trade that you make where you hope to take advantage of that positive interest rate and earn interest on a trade while you hold it. These rates, these fees that you pay, are called swap rates. BabyPips benchmark interest rates table is dangerously out of date. So you look at that table that they have there, it's no good. You should use something like this one. This is FX Street. I like FX Street in general. Their data is pretty good. And you can see what the major central bank interest rates are in one table on a page like this. Although, are these up to date? Let's see. Federal Reserve, 0.25. Yeah, that's accurate, I think. They reduced it now to between 0.25%. So I think that is true. And you can see the major central banks here, and then you can see different banks depending on the country. So generally speaking, this is a pretty good page to bookmark because every Forex trader should know roughly what the central bank of the currency that they're trading, what their interest rate is, and where interest rates came from, whether they're increasing or decreasing over time. Very, very important, very basic research that everybody needs to do, but most people don't. Okay. Yeah, and you still need to watch the news. So, for example, the Fed rate is 0, and when I was making this slide, they hadn't updated that, but now I think they have. What is a pip in Forex? You need to be able to, because the actual prices in Forex don't change a lot in real terms in terms of their unit currencies. Small changes in a currency's price will have a big effect on your profit or loss, especially because you're using leverage. So we need a way to measure currency price changes in much smaller fractions. And one way to do that is called a pip, a percentage in point, which is 1/10,000th a unit of currency. So basically, it's the fourth decimal point in a currency pair price. And then to cut it even more finely, you would have points. Now, BabyPips calls these pipettes or pipettes, but I've never heard anybody use the word pipette or pipettes. I've never heard anyone say that, not on a currency forum or anywhere. Most people just talk about them as points. A point is 1/10 of a pip, so 1/100,000th of a unit of currency. So, for example, with Fiverr, if it increases from 1.1050 to 1.1051, that 0.0001 US dollar rise in the value is equal to 1 pip. And a pip is usually the last decimal place of a price quote. Not anymore, because most brokers are 5-digit brokers. So the point is the last place of a price quote. Let's go back to this live thing and turn on one-click trading. You can see here in this number that it's listed in, but this is a yen pair, so it's a little bit different with yen pairs. Let's look at something that's not based on the yen right now. You can see that there's the 1.2245, so the first 4 digits are sort of, though they're all different sizes. They increase the size of these last 2 digits because they want you to see the value in pips, right? A difference in between this and this. But the small digit here at the end is the difference in points. So quite a good spread here with this broker on this particular currency pair, less than a whole pip. Boy, the pound is just dropping like a stone. Points are often shown as a smaller numeral after the pip value, so that's what I just showed you. So for example, if you had a price that says 1.31573, basically you can think of it as being 10,000 pips for this one, 3,000 pips for this position here, 100 pips over here, 50 pips over here, and 7 pips at the fourth position. And then you have 3 points at the end. I've seen some people accuse brokers of bringing in 5-digit pricing as a way of confusing people. Certainly it is confusing if you don't know about it, but actually it's just more accurate. And once you get used to it, it's not a problem. All right, how to calculate the value of a pip. Generally speaking, you won't need to. Arithmetic is not really a necessary thing that you need to be able to do while you're trading. But if you know how to do it, it's good. You can always go online and use a pip calculator. BabyPips even has one. Just look up the BabyPips pip value calculator and you'll find it. But basically, to calculate the value of a pip, you take the currency pair, you take the current value of the exchange rate, the change in the value, the delta in the counter currency times the exchange rate ratio is equal to the pip value measured in the base currency. So in this example, 1 pip of Canadian dollars times 1 US dollar to the 1.02 exchange rate in Canadian dollars. You do the math and you get a very small number of cents in US dollars per unit traded. So if you traded 10,000 units of the loonie, then a 1 pip change to the exchange rate would be approximately a 98-cent US dollar change in the position value, which is 10,000 units times that very small number that we calculated over here. It's approximate because the exchange rate actually as the exchange rate changes, so does the value of each pip move, right? Because a pip is just a fraction of a price when the price is the exchange rate is very large, that fraction will be bigger, and when the exchange rate decreases, that fraction is smaller. This is one reason why I am not a big fan of calculating or thinking of anything in terms of pips. Pip value are very different between currencies. They're very different between different regimes. And so something that fluctuates that much is not something that makes a good solid bedrock for calculating how much something has gone up or down. I'd much rather think in terms of real dollar amounts in the, or whatever currency you're trading in. I'd much rather think in those terms. So I think in terms of like dollars, how many dollars. I trade in US dollars often, or Canadian dollars. And so I think of how many dollars has this gone up or down. Much more useful to me than a pip. But pips are what people talk about, especially when they don't want to reveal how big their account is. Here is the BabyPips calculator, by the way. I'm just going to plug the URL for this. So there it is, babypips.com tools/pip value, pip-value-calculator. You choose the pair that you're trading. They have all 28 pairs there, it looks like. You put in what the ask price is currently, the position size that you're planning on putting on, the account currency that you're trading in, and then you press calculate and it'll give you the value of what a pip is. Yeah, calculations using pips, undesirable. Maybe that's the main lesson that you can learn from that. Because the yen is only a 3-digit currency, or if you're including pound points, it's a 4-digit currency. The calculation is a little different. It's calculated to a different level of accuracy. But anyway, you do the math, you use a calculator, you can't go wrong. So almost all brokers will work this out for you automatically. Things will be displayed and printed in ways that you can understand without having to do the math. However, it's not wise to trust too deeply or not to understand how the calculation is done. So definitely use a pip value calculator if you're not sure. And so here we go, another example of a calculation. Again, I borrowed this straight off BabyPips. If you're trading the loonie and the pip value is 98 cents US dollars in New Zealand dollars, then we would use 0.79 as the exchange conversion rate. Do the math, and you get a result of 1.2405 Kiwis per pip move. So basically, for every pip move in the loonie, an example above, a 10,000 unit position would change in value by approximately $1.24 in Kiwi dollars. Confusing, yes. And am I the best teacher to teach this? Probably not. But generally speaking, you don't need to know this in day-to-day trading, but it's good to know, or to sort of be able to grok the concept in general terms. All right, so that's chapter 2 of BabyPips.